Joining us now for an investment strategy session, we're joined by Sven Richter, who's MD of Frontier Markets at Renaissance Capital. Hi, Sven.
Hi.
Investment in Africa, I think often there are investors who could be in there but don't know enough and don't feel very secure, so are not there and are missing out perhaps. It's been a growth story over the last few years. If you've been invested in Africa, the earnings have been good.
The earnings have been very good. And it's driven to a large extent by the fact that the countries themselves are growing. So when you have people with more spending power, when the consumers are growing, when there's more infrastructure, then there's a lot of opportunities for the companies to look for business and to grow their business. And we have seen that particularly last year, where asset prices, based on some of the things that happened in Europe, were not particularly good. But the actual underlying growth in the company and their businesses in general has been very good. And this year we've seen that catch up in asset prices. And frontier Africa, so if you exclude South Africa out of it, so we're talking about your Kenyas, Nigerias and the other smaller markets, are up about 15% this year so far in US dollar terms.
Yeah. Let's look at the development of these markets, because there was once a great ideological debate about what underdevelopment was, and it would get worse. In other words, underdeveloped countries would not only not develop, they would go backwards. But perhaps the word undeveloped is better than emerging, because it does say that there's a big space to grow here.
There is, and see, I think that's what's very important. You know, sort of when people look at a country where it doesn't have as much resources or in terms of infrastructure as a developed country, they say, oh, this is a bad investment. But what they forget to consider is that that country has all that opportunity. Now, it's not to say that there aren't challenges in realizing that opportunity, but there's more opportunity than in a developed market, because they're putting in railroads. And every time you put in a railroad, there's more opportunity to get your goods to market and shave a few percentage points off your costs and make that for your shareholders. So we think that investing in markets that are underdeveloped or developing is a huge, huge opportunity for an investor.
Where would you say the stars have been, in both in terms of countries and possibly some big companies that have done well in those countries?
Well, you know, some of the, if you look in terms of absolute growth figures, some of the stars have been sort of the smallest countries, which even for ourselves, because our public equity investors find it difficult to gain direct access to. You know, countries like Angola or something like that, where you've had, you know, in the high teens, 20% or so GDP growth. So, I mean, that is obviously very attractive for an investor. And if you are either in a private equity fund or you're in one of the stocks that we buy which have operations there, you can benefit from that. But that is still relatively small, because those markets are so early stage in terms of development. The markets where we'd find most of our opportunities are where you can basically take a decent stake, something like Kenya or Nigeria, or in some of our international operations that are listed outside of Africa, but the operations are in Africa. And there you can get some stock, you can have a stake there, and you're still seeing growth of 8, 9, 10% from the companies.
What struck me coming onto this program was I'm accustomed to looking at the JSE, and one gets used to the kinds of numbers that the JSE produces. And you look at Kenya, you look at Nigeria and some of the other places. When there is a change, often it's big. So because the market's relatively small, if there's trading in a company, it can jump 10% or drop 10%. Isn't there money to be made and lost here?
Well, there is, and I think that's why, you know, as an investor, you need to be quite sort of focused and determined on what you do. And for us, you know, sometimes the short term, those 10 or 20% are not what we're looking for in terms of our investment style. We're looking for companies that make money fundamentally for themselves. And we believe that if you're in a company that makes money and it's making more and more money every year for its shareholders, the share price will take care of itself. And it follows, you know, in the JSE, your share price chart will sort of be quite jagged. It'll look, well, sometimes in these markets it looks like steps rather than being jagged. But yes, the opportunities are there for investors to make money.
The problem, of course, they're relatively small markets. They're not very liquid. They can just be stagnant.
They can be stagnant for a while, but, you know, as an investor, I think when you're looking in Africa, and when you're looking as an investor anywhere, we believe you need to be slightly longer term, and we're not in sort of talking about that you should move about every month, every 3 months, every 6 months. We think you should look in a 2 to 3 year process, and we believe that if a company every year makes more money, so you have a compounded growth, and we look for compounded growth of minimum 15% in US dollars from our company. So after 3 to 4 years, that company is almost double the size that it was before. Okay, your share price will respond. It won't respond on a day-by-day basis because of the liquidity, but at the end of 3 years, you're going to be a very happy shareholder.
Here's a question for you. ShopRite Checkers as an example, which has become, I think, the blue chip of the retail sector, where Pick n Pay once was in South Africa. They have done an African success story. Whitey Basson's style is to shoot first and ask questions later. He's gone there, he's done things. Do you need to invest in Africa, or are you investing in Africa by buying Shoprite Checkers shares in South Africa?
Well, the problem I have with Shoprite, and not that it's a bad company anyway, I mean, I think it's a fantastic company. I think they're doing fantastic things in Africa. But because South Africa is relatively still so large in terms of markets and retail markets compared to the rest of Africa, where the opportunity is, but it hasn't been taken care of, you're still getting most of your earnings in Shoprite from South Africa. So you only get a small sliver from Africa. So
and that applies to most.
And that applies to most. I mean, there are some exceptions. I mean, MTN is obviously the exception where you have a much larger share from Africa. So, I mean, for us, we would say, well, why not buy directly? Why not buy into the, for instance, Thomas Meikle's TM in Harare, which Pick n Pay has just gone up to 49% in, okay? Or Chumi supermarkets in Kenya, or some of the Nigerians. Why not buy direct into those and get 100% focus at the moment? And Shoprite is interesting, but it's still, if you want to focus on Africa, it's still a fairly small sliver of its business.
I know investing is easy except for the timing, but Zimbabwe, clearly there's a huge growth story to come where the right company, you've got shares in it when the turnaround comes and the political situation sorts out.
I mean, we have been seeing so much opportunity in terms of Zimbabwe. What was amazing also was I went there about 3 days after they took on dollarization. Well, it's a mixture of rand, pula, dollars, whatever, but they got rid of their currency. Inflation went from uncountable every day to basically zero. The supermarkets were stocked within a couple of days. The department stores and that all took some longer to stock. And the economy started booming. You had huge increase. Actually, our investments in Zimbabwe have probably gone up more than any of our other investments because it really just got back to where it should be. And there's still gaps for that. But timing, okay. There's a presidential election coming up.
How long till Mugabe goes is one question.
Well, and you don't know whether if Mugabe goes it's good or bad, because remember that you don't quite know who's going to take over and you don't know what their policies are going to be.
Will there be stability?
That's exactly the question. But at the same time, you have huge diamond fields. You have agriculture that can easily bounce back in a very good company where the whole environment is built around agriculture. So, you know, we've seen beer sales going up, we've seen mobile phone sales going up. So Zimbabwe, we still think is a huge opportunity.
Final question, banks. Just get the impression that banks in Nigeria, Kenya, leading the stock exchanges there recently. Cement sales in South Africa, PPC, and also Dangote Cement in Kenya, just two examples.
Dangote is also coming to South Africa, by the way, okay? But yes, Dangote is expanding. They're now exporting into West Africa. They're busy putting plants down in various other parts. You have not just Dangote, but many other cement producers. So the banks are leading in terms of regionalization. The cement companies are also going to lead in terms of regionalization. And that for us is an important sign that Africa is growing as they do more business between each other.
What a great interview to have had on our Africa Day, insights into investing in Africa. That was Sven Richter, who's MD of Frontier Markets at Renaissance Capital.